Canada's national anthem celebrates the true north, strong and free. It isn't really free, but it is an awful lot cheaper than it was. Today, the Canadian dollar, appropriately known as the loonie, fell through 110 to the US dollar for the first time since mid-2009. It's lost 70% of its value in the last 2.5 years alone. Now, almost everyone seems to be betting against the loonie. Speculators in the futures markets short more than 100,000 contracts for only the third time in 2 decades of data. Canada's problem isn't just a stronger US dollar though. It's a developed country which behaves financially much more like the emerging world, something reflected in the close link between the value of the loonie and of emerging market shares. For years that was a great place to be, but today not so much. This chart shows why. Canada's economy is built on commodity exports, demand for which has come primarily, of course, from the emerging world, and particularly from China. The red line on here shows the real value of the Canadian dollar against a basket of trading partners, and in blue we've got the inflation adjusted value of the longest running commodity index, the CRB spot index. Now, broadly speaking, the higher commodity prices are, the higher the loonie goes, and vice versa. There's a pretty tight link over here since 1985. That's a fairly long series of data. Of course, it's not perfect, but it's pretty good. You can see that the loonie is, actually you can't tell particularly, but the loonie here is a fair way above its average over that period since 1985, which would bring it down to around here, although of course there's no particular reason why the currency should trade anywhere close to that level. Now, determining the direction of the loonie from here means determining the direction of commodity prices. The outlook for demand is tied not just to the growth of the world economy and so use of commodities, but also to the changes underway in China, where it's trying to shift away from infrastructure investing more towards consumption. And again, that'll lead to a reduction in those large commodity uses in the building of houses, roads and railways. But traders betting against the loonie should be paying close attention to the demand side as well. Shareholders of miners have defenestrated the executive teams which splashed money on digging big holes around the world. Capital spending is under pressure for the first time in years. Now, this is eventually going to restrict supply and push up prices. But of course, for the moment, many of those new mines are only just coming into production. This chart shows the relative performance of mining shares, that's the red line, relative to MSCI World, and the value of the dollar, here I've used the dollar index, is in blue, and that's inverted. Now, the weaker the dollar, which of course means the higher up the blue line is, the more likely mining shares are to beat the wider market. Now, this shouldn't really be a surprise since commodities are priced in dollars. A weaker dollar means a higher price for those commodities. If the strengthening of the dollar that we've seen, it's very slight, but if that strengthening that we've seen in the past month continues, then that ought to be bad for commodity prices, in turn for shares in miners, and so eventually for the loonie. On the other hand, any reversal in the sentiment that we've been seeing towards both metals and mining and the emerging world and the Canadian dollar could be very violent indeed, thanks to those near record bets against the loonie, because they'll all have to be unwound in a hurry.